friends, welcome to the ABM Crash Course day number 7, and today we are going to discuss our unit number 24, and the chapter is restructuring, rehabilitation and recovery. So here it will be why also. So let's dive into this chapter, and we will simplify the all important concept from this particular chapter. So friends, ever wondered how borrower who have the money still manage to escape payment? So let's break down the sequence of willful default. Right, this is called willful default action that lead to massive financial loss. So step number 1 is the capacity to pay. The borrower has the capacity to pay, right? So what it means that the borrower has enough money to repay but choose a different path. This is called intentional default. This is called intentional default. Means instead of fulfilling obligation, the borrower deliberately stop making payment. Why? Because they have other plan, or they can. This is called the misuse of fund. The money meant for repayment is redirected to unauthorized purposes, maybe luxury, maybe risky investment. That is called misuse of fund. And the next is siphoning of fund, which means that now things get serious. Fund are moved away from their intended use. So basically there is something called intended use of the fund, like this is called hidden, or we call it transferred. So when I say siphoning of fund, what it means that fund are moved from their intended use. So every fund has their intended use, but where it is used? Somewhere else, right? Like hidden, transferred or funneled somewhere. And step number 5 is the disposal of secured asset, which means the borrower sells secured asset. What is the meaning of secured asset? The meaning of secured asset? Secured asset means which were collateral for the loan. So secured asset just means the collateral for the loan, right? So borrower sells secured asset without even informing the lender, right? So this is called disposal of the secured assets. So borrower, once who had availed the loan, they sell secured asset without informing the lender. So he has total breach of trust. So these are the effect of this willful defaulting. So it may be intentional default, it may be the misuse of fund, it may be the siphoning of the fund, or it may be the disposal of the secured asset. And just like that, the bank suffer huge loss while the borrower walk away scot free. So friends, if you want to know how bank tackle and track this willful defaulter, right? So let's stay tuned. Let's move to the next slide. And in the next slide, we are just going to discuss the same. So there is something called financial management, diversion and siphoning of fund. So ever wondered how companies secretly misuse fund? So let's uncover the two biggest trick in financial mismanagement. The first is called diversion of fund. What is the meaning of diversion? See, money meant for one purpose is redirected elsewhere. How? So for example, using short-term capital, you are using short-term fund for long-term need. This is one way. You are using short-term fund for long-term need, or you are transferring money to a group company, or you are sending fund to unauthorized bank, or you are making investment without approval, and finally, and worst of all, failing to account for the money. So these are the different way of diversion of fund. So question may be asked, which of the following represent the diversion of fund? So you must know that these are the diversion of fund example. Like again I am repeating that you are using short term fund for long term need, or you are transferring money to group company, or you are unauthorized, or you are, so suppose you are sending fund to an authorized bank, or you are investing without approval, and worst of all is failing to account for the money. So these are called diversion of fund. And the second part is the siphoning of fund. What it means? So this is where things get shady. So when I say siphoning of fund, this is where things get shady. So fund go into unauthorized activity, right? Fund goes into unauthorized activity. The company financial health takes a hit, and even lender assessment get manipulated. This is called siphoning of fund. So siphoning of fund, under siphoning of fund, things get shady. Fund goes into unauthorized activity, right? The company financial health takes a hit. Even lender assessment get manipulated, and just like that, investor and bank suffer massive loss while the culprit walk away free. So understand the difference between diversion and siphoning, right? So friends, question may be asked that which of the following represent the siphoning of fund? So suppose fund goes into unauthorized activity, the company financial health takes a hit, lender assessment get manipulated. So these are the cases of siphoning of fund. I hope that makes sense to you. So how this diversion and siphoning works, so this can be clearly understood from this particular slide, and this is how we represent the data in our entire crash course, right? So if you want data, if you want to revise the content very shortly, very effectively, if you want to remove the scrap and only remember the important point, you can enroll in our CAIIB crash course program. For more detail, you can WhatsApp me on this particular number to get detail regarding this particular crash course program, right? So this is a sample PDF, just I am showing you. You will get PDF for every unit like this. Only important thing that matters from examination point of view has been represented in the pictorial format, so that you can remember them for a longer amount of time. So now let's shift our focus to our next slide, and the next slide you can see is a very good important question. Let's answer this question. Imagine a borrower. So the question is, when is a borrower considered non-cooperative, right? Imagine a borrower deliberately blocking the recovery process. So should they be labeled non-cooperative? Let's find out. So first thing is that withholding information. Try to understand withholding information. What it means, that that some borrower refuse to share crucial financial data, making it harder for bank to recover dues. So no transparency, no trust. First point, the second point is denying the asset access. What is the meaning of denying asset access? So when lender try to recover financial asset, these borrower restrict access, so obstructing the process. And obviously, is this a red flag activity? Absolutely, this is a red flag activity. Means when lender try to recover finance asset, these borrower restrict the access, obstructing the process, and obviously this is a red flag activity. And the second thing is obstructing the security sale, which means the borrower goes a step further and block the sale of security, delaying financial recovery. But banks are prepared. If the total exposure exceeds 25 crore, you must note it down. If the total exposure exceeds 25 crore, right, the borrower and even promoter or key manager can be classified as non-cooperative, right? So these are the conditions under which a borrower can be called non-cooperative: if he is withholding information, if he is denying asset access, and if he is obstructing the security sale, right? So under this case, he can be called non-cooperative. And once that happen, strict action will follow, right? So bank must protect their fund. But what more they can do to prevent such cases? Let's find out, right? So friends, now let's move over to the not every borrower. So the question is, how is the borrower status evaluated? Not every borrower is the same, and bank follow a structured process to decide if a borrower should be classified as non-cooperative or given another chance. Let's break it down. First of all, they issue something we call show cause notice. So a formal notice is sent to the borrower, giving them a chance to explain why they defaulted. Right? So this is the chance, they give it a chance to explain why they defaulted. So a formal notice is sent to the borrower, giving them a chance to explain that why they defaulted. Then comes personal hearing, right? So if needed, the borrower can present their case to the authority. A fair chance is given before taking on any strict action. The next thing is the committee review. So a higher committee led by the chairman or CEO and two independent directors review the case and decide if the borrower should be classified as non-cooperative. And then reporting to CRILC. I think you are familiar with this CRILC. We have talked about it in the previous lecture. So what is reporting to CRILC means? So once a borrower is declared non-cooperative, bank must report them to CRILC. What is CRILC? CRILC stands for Central Repository of Information on Large Credit. What is the full form of CRILC? Central Repository of Information on Large Credit. So this is called CRILC, right? Central Repository of Information on Large Credit. So once a borrower is declared non-cooperative, bank must report them to CRILC within 21 days. How many time period is there? 21 days time period is there. So their status is reviewed every 6 months for possible declassification. A status is reviewed every 6 months for possible declassification. And the final step is a risk assessment, which means bank assess the risk involved and make necessary provision to protect their financial stability. So assessment of risk is done and provisioning is done. Means necessary provision is made to protect their financial stability. So a well-defined process ensures that genuine borrower get a fair chance while the willful defaulter face a strict action. Right? So the question is answered now. So what was the question? That how the borrower status evaluation process is done. So cause notice issued, personal hearing, committee review, report to CRILC, and risk assessment. Now let's switch gear and let's talk about bank account rectification. So now the topic name is restructuring, rectification and recovery. Now let's look at rectification. How rectification is done? So when borrower struggle with repayment, bank don't take immediate strict action. Instead, they follow a well-structured rectification process to help both parties. The first thing is that bank identify the stressed account, which means bank first identify account that need rectification to prevent further financial distress. Then they persuade the borrower, which means rather than enforcing penalty right away, bank try to encourage borrower to clear their dues and regain financial stability. or transfer to other bank, which means if necessary bank facilitate account transfer to other financial institution that may offer better terms, or consortium lending action. In some cases multiple banks step in, one bank may take over the share of the loan, spreading the risk. Or in the next step there is something called sole banking challenge. What is the meaning of this so called sole banking challenge? Sole banking challenge means exiting sole banking arrangement can be difficult, right? So adding complexity to the rectification process, or obviously withdraw concession. If no resolution is found, bank may remove financial benefit previously granted to the borrower, or enforcing covenant, which means at this stage strict financial agreement are implemented to ensure compliance and recovery. And finally is the reducing the limit. So bank may reduce the limit, right? So this is another step that is called reduction of limit, right? Restricting further borrowing until the borrower situation improve. So these are the steps that the bank can take, right? Reducing further limits. So this multi-step approach ensure that borrower get opportunity to rectify their financial position while bank protect their asset, a win-win strategy. This is called the rectification stage. So let me summarize the fact. The first is transfer to other bank or identify stress account, persuade borrower, consortium lending action, sole banking challenges. These are the main points which you have to go through. Now let's look at the restructuring. What are the steps to restructuring? So ever wondered how a struggling business get back on track? So financial restructuring is the answer. Let's explore its 6-step process that help business regain stability. First of all, you have to identify the viability. What is the meaning of viability? Means is to assess whether the business has the potential to bounce back. If it is viable, restructuring can begin. So first of all, you must check that yes, if it has potential to bounce back, then only you begin this restructuring process. If it is not, don't begin. Then you have to demonstrate the commitment, which means the borrower must show seriousness toward repaying the loan and cooperating with the restructuring process. Then extend repayment. So to ease the financial burden, bank increase the repayment period. What bank do? Bank increase the repayment period. So this is one way of restructuring, that you increase the so suppose repayment period initially was 20 year, they may increase to 25 or 30 year, right? To ease the financial burden, bank increase the repayment period, or to reduce the installment amount. So two things can be done, either increase repayment or to reduce the installment. So what is the meaning of reduction in installment? So lowering the amount in each installment to make repayment more manageable. So this make repayment manageable. And lower interest rate. Obviously interest rate is lowered, which means restructuring offer include reducing interest rate, making borrowing more affordable. And or to convert the dues, means finally bank converts short term debt into long term loan, ensuring a smoother repayment and business continuity. So following this step by step process, business get a second chance and bank protect their asset, a well structured win-win strategy, right? So this is how restructuring is done, right? Let me again show you the step. Viability, commitment, extend repayment, reduce installment, lower interest rate, or to convert the dues, that means convert debt into long term loan. These are the steps that the bank can take for restructuring. Now look at the loan recovery. So now let's shift our focus to the recovery part. So friends, ever wondered what happened when borrower failed to repay their loan? So bank and NBFC non-banking financial company. So bank and NBFC they have a structured legal recovery process. They have a structured legal recovery process to ensure that their dues are collected. So first step is to initiate the legal proceeding. What it means, that if a borrower does not clear their dues despite multiple chance, bank initiate legal recovery. What I'm telling you, that suppose borrower does not clear their dues despite multiple chances, right? Multiple chance were given to the borrower but they did not clear their dues, so bank initiate legal recovery. This is the first point. Second point is to civil court suit for amount below 20 lakh, which means for a smaller amount bank filed suit in civil court to get the money back, right, up to below 20 lakh. So if the amount is below 20 lakh, bank filed suit in the civil court. Now the third step is the preliminary decree and the repayment period, which means once the court acknowledges the case, borrower may get 6 months to repay before further action. So this is called preliminary decree. 6 month timing is given to the borrower for repayment after preliminary decree, right? So if it is below 20 crore, then 20 lakh, then only. Then we have final degree for execution, which means if the repayment does not happen, a final decree is issued allowing recovery within 12-year execution limit, right? And DRT process, if the repayment does not happen, and for larger amount above 20 lakh, below 20 lakh, the court, they can go to the civil court.
But larger loan cases are taken to a DRT for a faster resolution, which is called debt recovery tribunal. Even NBFC with asset over 100 crore, right, can approach DRT to recover their dues. So this legal framework help bank and NBFC recover loan systematically, ensuring financial stability. So these are called recovery process, right? Now let's look at the Lok Adalat. You know, Lok Adalat is another way. Let me show you the importance of Lok Adalat here. So in this slide you will understand overview of the Lok Adalat function. So friends, ever wondered if there is a faster, easier and cost effective way to resolve dispute without getting stuck in lengthy court cases? So well, Lok Adalat is a solution. So it is a unique dispute resolution mechanism under the LSAL, right? That is called remember this, Legal Service Authority Act 1987, right? Designed to settle the case amicably, right? It is designed to settle the case amicably. So it handle judiciary cases. It handle judiciary, civil judiciary cases. So Lok Adalat can resolve civil case up to 20 lakh, right? Making justice accessible and efficient. And there is something called dispute resolution platform. So it provide an alternative to the traditional court where both parties reach a mutual agreement, avoiding expensive legal battles. DRT and DRAT cases. So for some cases there is no monetary limit. This means high value dispute can also be settled through this mechanism, right? So Lok Adalat promote speedy justice without the hassle of prolonged litigation, no court fee, no delay, just fair resolution, right? So this is the advantages of the Lok Adalat. Up to 20 lakh cases are handled in the Lok Adalat. Now the next point we have to discuss is the SARFAESI Act. Very very important. So ever wondered what happened when a borrower default on a loan? So bank don't always have to go to court. Thanks to the SARFAESI Act 2002, lender have a structured way to recover their dues efficiently. So first step is to lender identify the default, which means when a borrower fails to repay, lender makes the account as default. Then we have to enforce the security interest. Unlike regular legal battle, bank can seize asset without court intervention. This is called enforcing the security interest. Then they sell the asset to ARC, asset reconstruction company. So to recover their money, bank can sell their asset to ARC, which is a smart way to manage the bad loan. And or we can say the borrower appeal to DRT, which what is the meaning of DRT? Debt recovery tribunal. So if the borrower disagree with the bank action, they can approach the DRT without needing to pay upfront fee. And the appeal process, this case must be resolved within 60 days, ensuring the speedy justice, right? So this case must be resolved within 60 days, ensuring the speedy justice. And then we have aggrieved party appeal to DRAT. If unsatisfied, the borrower can further appeal to DRAT, that is the debt recovery appellate tribunal, for another review, right? And finally it is called magistrate assistance. So if required, bank can seek help from the chief or district magistrate to check position of the secured asset. So this entire process ensure bank can recover loan efficiently while borrower still have the right to appeal. A win-win for all, right? So this is how the SARFAESI Act work. I've just given you the preview of it. Very very important points. DRT, DRAT, how many days appeal process to take? 60 days. So remember these key points, right? So appeal process with case disposal within 16 days. Next 45 days it has to deposit half of the fine, right? Half of the asset. Okay, so that has to be deposited for DRT, right? For appeal to the DRT. Then we have the write-off process in banking. So have you ever wondered what happened when a bank failed to recover a loan? Does the bank just forget about it? Not really. This is where the write-off process comes into play. So let's break it down step by step. First of all, this is called initiate write-off, which means when recovery effort fail, the bank decide to write off the debt, right? So first of all, this recovery effort. So whenever this recovery effort fail, what happens? What the bank decide? So bank decide to write off. Bank decide to write off the debt. But wait, this does not mean that borrower is off the hook. So they use something called provision, right? The outstanding amount is offset against provision. And what is provision? Provision is like a financial buffer that bank maintain to cover the bad debt. This is called provision. Or they debit the profit and loss account, right? So when the recovery effort fail, then bank write off the asset. Or they use provision, or they debit the profit and loss account. Any shortfall is recorded in the profit and loss account, impacting the bank financial. And borrower's liability remain even after the write off. The borrower is still liable for the debt, right? Bank can still take action to recover their money. Or the claim future receivable, future recovery. So what it means, that the write off does not mean that bank give up. If the recovery become possible in the future, the bank can still claim it. Or clear NPA. This is very important, that a technical write-off help clear non-performing asset from the bank book making financial report look healthier. And debit non-recoverable asset. In some cases, the debt is classified as non-recoverable and permanently debited. And sometimes, preserve value. Timely write-off help bank preserve the value of money and keep their financial stable. So the next time you hear that bank has written off a loan, remember it is a financial adjustment, not a free pass for borrower, right? So this is what is done. It is recorded in the profit and loss. MSME are the backbone of our economy, but sometimes financial stress hits hard. So what happened when an MSME struggle to repay loan? So the banking system has a structured process to resolve such case. First of all, what they do, let me explain step by step. The first step is to form a committee, right? As you can see here. So a team of expert, including bank official, MSME representative, and government officer, is assembled to oversee the resolution process. So the regional or zonal head acts like convener. Then they have to refer the account. What is the meaning of referring account? Basically, if an MSME has loan above 10 lakh, right? Suppose MSME has loan above 10 lakh, the account is referred to the committee within 5 days for a resolution plan. That is called RP, right? So basically, first they form a committee, and if the MSME has loan above 10 lakh, then account is referred to the committee within 5 days. Within 5 days, they have to refer the committee to assess whether a resolution plan is needed. So the assessment is done that whether RP is needed or not. Then what they do, they approve the recovery process, right? Next step, as you can see, is the approving the recovery process. Means this committee, right? I told about the committee. So this committee evaluate different recovery and restructuring option and grant approval for the best possible solution. This is the third step. And step number 4, for large exposure, a techno-economic viability, that is called TEV. What is the meaning of TEV? TEV stands for techno economic viability, right? So for large exposure, this techno economic viability, it is conducted to check whether the MSME has the potential to recover and sustain. And finally, they approve the resolution plan. So the resolution plan is finalized and approved, including necessary provision to help the MSME get back on track. So why this process important? Because it ensures that MSME get a fair chance to revive, while the bank mitigate risk and recover their fund. So what do you think? Should more MSME be given a structured resolution plan? Drop your thought in the comment. Now let's look at the next point. So friends, when a bank restructure a large loan or changes ownership, an independent credit evaluation, that is called ICE, right? So whenever, two things I'm telling you, whenever whenever bank restructure a large loan, so either they are restructuring a large loan or they are changing the ownership, or they are changing ownership, an independent credit evaluation is mandatory. But how many IC are actually needed? How many independent credit evaluator are actually needed? Let's simplify it. So question is, how many credit evaluation are needed for large loan restructuring? So again, I am telling you, for large loan restructuring we are talking about. So suppose for the loan that is less than 100 crore, right, just one IC rated RP4 or better is required. For loan of 100 crore or more, right, one IC with at least require one IC rated RP4 or better is mandatory, right? And for massive exposure of 500 crore and or more, two IC are needed and both are rated RP4 or better, right? So this is the point you must keep in mind, right? So basically, why this is important? Because these evaluation ensure that restructuring decisions are based on expert opinion, reducing risk for both the bank and the borrower. So IC full form, independent credit evaluation. This is called IC. So you must know how many IC are required for the resolution process involving restructuring or ownership change with 100 crore or more. You must know it. Now let's talk about achieving restructuring plan implementation. So friends, a successful restructuring plan is not just about approval, it's about execution. Let's walk through the 5 crucial steps to ensure smooth implementation. So the first thing is that the borrower must not be in default with any lender by the 180th day after the review period. This is the first major checkpoint in the process. So there is something called review period. After review period, within the 180th day, borrower must not be in default with any lender. Second thing is to complete the documentation. Means all necessary document must be prepared, signed and recorded to reflect the restructuring term in both lender and borrower record. Third thing is the security creation. Any collateral, any security requirement must be finalized as a part of restructuring process to ensure financial protection for lender. And finally, the loan term modification, which means all agreed change in the loan term like interest rate, tenor must be properly documented and accepted by all party. And finally we have no default post implementation, which means after even after restructuring is complete, the borrower must stay compliant with all lender to avoid falling back into financial trouble. So because proper restructuring can revive business, prevent bad loan, and ensure a win-win for both bank and borrower. So here is a question for you: should bank allow multiple restructuring for the same borrower, or should it be one time chance? Please answer it. So this is how restructuring plan is implemented. Now let's switch our focus to lender provision timeline for a borrower default. So let's talk about it. So friends, when a borrower failed to implement a valuable resolution plan on time, so suppose a borrower is failed to implement viable RP on time, right? Lender must follow a strict provision timeline to safeguard their financial. First of all, the thing is review period end, which means the initial review of the borrower financial condition is implemented. If the issue remain unresolved, lender must set aside 20% of the total outstanding, which is the funded plus non-funded, right, as provision after the 180 day from the review period end. So suppose review period end in Jan end. So after 180 day, 180 day means Feb, March and April. After April end, right? So after ending of April, so initial review of the borrower financial is completed. If the issue remain unresolved, lender must set aside 20% of the total outstanding as provision after 180 day from the review period. So if after the 180 day of the review period, if the issue remain unresolved, then this much provision is to be done. So lender must now assess the borrower financial situation and allocate provisioning accordingly. This is the first major financial buffer to avoid potential loss. Then we have 365 day provision deadline. If the default still persists, lender must increase their provision by another 15%. So earlier it was just 20%, and now it has increased to 35%, right? So this step ensures that risk is properly accounted for in the bank's book. So lender calculate the necessary provision based on the outstanding amount. So it's all these are done on the basis of outstanding amount, right? The amount set aside is capped at 100% of the total outstanding, depending on the asset classification and existing provision. And then some additional provision apply. At this stage, all lender with exposure to the defaulted account must make an additional provision, reinforcing financial discipline and risk management. So this is called additional provision is applying. So basically this timeline ensures that bank remain financially stable despite borrower default. So here is a question for you: should lender have a strict timeline, or do borrower need more flexibility to avoid default? Please answer it. So these are the steps: review period ending, 180 day provision deadline, 365 day provision deadline, provision calculation. So how do you calculate the provision? So lender calculate the necessary provision based on outstanding amount, and the amount is capped at 100% of the total outstanding. Try to understand. These provision are over and above the higher of the existing provision, and those required by the asset classification capped at maximum it can go to 100% of the total outstanding. That is the maximum provisioning can be done, right? 20% and 35% are the deadline. Now let's look at DCCO, very important part. So friends, have you ever wondered what happened when the borrowing entity delay the commencement of operation? So bank follow a structured process for classifying such loan, ensuring financial discipline, right? So first of all, when operation begin, that is called DCCO start, right? DCCO start. So what is the meaning of DCCO? DCCO means date of commencement of commercial operation. Date of commencement of commercial operation. This is called DCCO. So the DCCO mark the official start. From here, interest capitalization stop. Interest capitalization stop. What it means? That interest capitalization stop, and all expense start reflecting in the profit and loss account. All kind of expense are started reflecting in the profit and loss account, right? So this is the point. Interest capitalization, no more interest capitalization is there, and all the expense are recorded in the profit and loss account. Now the question is that is there any is there any need to defer the DCCO? At this stage, bank assess whether the project need a DCCO deferment. If yes, then the loan undergo restructuring, means leading to asset downgrading, or riskier classification. And if no, if deferment is not there, the bank check whether the revised DCCO still fall within the permissible limit. So the bank check whether the revised DCCO still fall within the permissible limit, and lender allow deferment within these limit up to 2 year for infrastructure project and up to 1 year for non-infrastructure project. This is the maximum deferment that the lender can allow. And if the revised DCCO remain within these limit, the loan is classified under a standard category, right? So if the deferment was no, yes, then restructuring is done. If it is no, then it is a standard category, right? And what if it exceed this limit? So if it exceed this limit, if the deferment exceeds the permissible limit for 1 year for infrastructure project, or 2 year for 2 year for infrastructure project and 1 year for non-infrastructure project, if it exceeds it, then then further deferment lead to additional provisioning. Then further deferment is done and additional provisioning is there. And what if it exceeds this limit? If the deferment exceeds the permissible limit, further deferment lead to the additional provision. Because the process ensures that bank properly classify loan and account for risk, preventing financial instability. So should bank allow more flexibility in deferment, or would that increase financial risk? Please answer. Now this is a very important chart table from where you will understand this deferment. Very important. Case study is asked. So did you know that when a project faces delay, bank don't just wait. They reclassify loan and adjust provisioning accordingly. Let's break down how deferment in DCCO work. So the step number 1, as you can see, is the first deferment. For first deferment, so if it's infrastructure project, 2 years is allowed, I told you earlier. And if it's non-infra project, then 1 year is allowed. And these loan remain classified as a standard asset, and 0.40% provisioning will be done. Step number 2, deferment due to reason beyond promoter control. And if the infrastructure project, extra 1 year is added, right? Extra 1 year is added, this means T plus 3 year. And if it is non-infra project, then 1 year is added, that is T plus 2. But here is the catch: the provisioning requirement jumps to 5%. Earlier it was just 0.40%, now it is 5%, right? Applicable for 2 year or till revised DCCO, whichever is later. Step number 3, what if deferment due to arbitration in or court case? Suppose some court case is there, because of which deferment is happening. So if it is infra project, then additional 2 year, that means total T plus 4 year is allowed. And if it is non-infra project, it is limited to T plus 2 year only, like in this case as above. And if the deferment, if the promoter is changed, what will happen to the deferment? So it can go up to 6 year, and for non-infra project, it can deferment capped at 4 year. So bank carefully regulate project delay to balance financial stability and ensure loan don't turn into bad asset. That is why this deferment is done, right? So and that is how provisioning is done. Now let's look at the last topic of this particular chapter. So have you ever wondered what happened when the bank struggled with the bad loan? Well, RBI has a structured framework for selling financial asset, ensuring a balance between recovery and financial stability. First of all, you have to identify the financial asset. This is the first step. You have to identify the financial asset, right? So this process begins when the bank evaluates their asset. Is the asset an NPA? If yes, then bank can sell to security company or reconstruction company. And if no, the bank check if the asset is under a standard asset under consortium, right? Try to understand the step by step. Is it under NPA? Then you should either sell. If it is yes, right? So if it is the asset is an NPA, they can either sell to ICRC. If no, the bank check if the asset is under standard asset under consortium or not, right? Now another critical check, right? If the 75% of the asset value already classified as NPA, is the 75% value already an NPA? If it is, then then if yes, the bank can proceed with the sale to the SC and RC. And if no, then bank do not sell the asset. Now step number 4, what if the asset is not NPA? Right, what if the asset not NPA? So the asset is in SMA 2 category, which is called a special mention account 2 category. So it signals the potential stress. So the question is restructuring possible? So this is the question: is restructuring part of the plan? Right. So friends, if yes, then additional financial finance is arranged to support revival. If no, the bank may reconsider a strategy. So this framework help bank make informed decision, either selling a stress asset or reviving them with additional support. So do you think that banks should have a stricter rule for asset sale, or should there be more flexibility? And the last slide here we have NPA sale and valuation process. So basically, ever wondered how bank get rid of their bad loan? Well, they don't just write them off. They follow a structured process to sell non-performing asset and recover when they can. So whenever a loan turn into NPA, the bank decide to sell it to recover some of its loss. So the buyer of the NPA must hold it for at least 12 months before taking further action, right? So the buyer retains asset for 12 months. Then there is something called public bid solicitation. To get the best price, bank invite public bid and conduct e-auction for competitive participation. And there is something called internal valuation policy. It means bank have internal system for asset valuation to ensure fair pricing before selling. And then there is external valuation for large exposure. So for large NPA, bank must obtain 2 external valuation report to ensure transparency. So this process help bank reduce bad loan, clean up their balance sheet, and improve financial stability. So this is all about this particular chapter. If you want to get such kind of content, you can enroll in our crash course. For more detail, you can WhatsApp me on this particular number, and in the description section